The old saying, you don't know what you don't know, becomes really relevant when applied to a specialized industry like CMBS loan restructuring. Hi, I'm Bill Stuckman with First Service Solutions, and I'd like to share 5 myths of restructuring a CMBS loan. That way you'll know what you didn't know before this video. Myth number 1, that no means no. Just because a special servicer rejects an initial request does not mean that ultimately a loan modification can't get done. The special servicer is under no obligation to counter with a proposal that will result in a successful workout. It's the borrower's job to drive the intense negotiations to arrive at a compromise. Compromise isn't always driven by the current economics of the property or the financial capabilities of the borrower. Myth number 2, that your loan is a special servicer's top priority. Most asset managers are dealing with 20+ loans at a time. Each loan requires an appraisal, opinions of value, and third-party reports are obtained to guide the process. In addition, the special servicers are reviewing and approving disbursements from cash management accounts, preparing internal reviews and presentations, conducting independent research, and a myriad of other tasks. They simply do not have the time just to focus on your loan. But when they do, a borrower must act decisively. Myth 3, that you can go through the process without financial projections. Special servicers will always weigh the future performance and value of the property, as they have the option to recommend that a receiver is put in place and that the trust acquire ownership of the property through foreclosure. They then have at least 3 years to sell the property. The future upside or downside weighs heavily in formulating the strategy and directs the decision of the special servicer. Another myth is that the modification will not cost you. All special servicers will require that the borrower provide an additional investment beyond the fees and costs associated with the special servicer processing the modification. These costs might include providing additional funds for capital improvements, tenanting and leasing costs, interest reserves, and bringing escrows and loan payments at the modified terms current at the time of the closing of the modification. And the last myth I'll mention, but there are more, is that the terms and requirements of the modification last for the life of the loan. With the exception of an A-B note split restructure, most modifications are for a term of 2 to 3 years. After the modification period is complete, assuming that all the provisions of the modification have been met, the loan will return to its initial terms and be governed by initial loan documents. To learn more about restructuring commercial loans, please visit our website at First Service Solutions.